Guys, welcome back. How are you? This is Christopher Aaron. It is March 4th by the time you will see this, 2021. And we're going to have a gold price update today. I hope you're doing well. Gold has been very weak over the last couple of months. So what we want to do is have a quick update this week to look at some of what is going on from a technical basis in the gold market. Now, before we do that, let's just talk for a minute about what has actually been impacting these lower gold prices. And before we get to that, however, make sure to hit the big red subscribe button and the bell icon so that you will get notified when these free videos come out on YouTube. So what has been causing these lower gold prices over the last few months? It's been very interesting to follow the cause and effect here that the markets have been subscribing to. What we have seen is commodity prices rise strongly over the last 4 months. We're talking the price of oil is up almost 75%. We're talking the price of corn and wheat and natural gas, all up, up, up. Platinum, right? Copper, up, up, up. Why are all these commodities higher? It's because of inflation. It's because all of the inflation that the Federal Reserve created and the U.S. Treasury created during the coronavirus panic exactly 1 year ago, all of that inflation is coming home to roost. For every cause, there is an opposite and equal reaction. That is one of Newton's famous laws, right? Nothing is for free. You can't have something happen without there being a reactionary event on the opposite end of the spectrum. So all that inflation was printed, all that money was printed and created digitally out of thin air. And we're starting to see all the commodities, all the hard assets rise in price. Now this makes sense. The second thing that is happening is that because inflation is starting to be seen in the system, bond investors in U.S. government bonds, are selling their bonds. That's the second chain of events. Now, this also makes sense because if there's higher inflation, you don't want to be owning a bond that's paying you 0.5% or 1% per year, right? It doesn't make any sense. You're losing money on real interest rates. So it makes sense that bond investors are selling their bonds. Okay, so far, 2 for 2. There's 2 things that are happening, and both of them make sense. Now, we know that when bonds fall in price because investors are selling them, what happens? The interest rate on those bonds goes up. It's a seesaw. As bond prices go down, the interest rates rise. Direct cause and effect. So, the third chain in this whole series is that interest rates have risen over the last several months. Remember the original cause for this, because we're getting now into the third thing, and pretty soon we're going to get to gold. Remember the original cause. The original cause is higher inflation. In other words, a debasement of the currency, causing commodity prices to rise, causing bond investors to sell their bonds, causing bond interest rates to go up. Now, the fourth part, when we get to the gold market, is that gold investors are selling their gold thinking that they can get a better return with bonds that are now paying higher interest, such as the 10-year bond, which is now paying almost 1.55%. So the last part of this chain, this cause and effect, is completely illogical. Because if you go from the first step, which is there's higher inflation, to the last step, which is therefore gold investors are selling their gold, it makes zero sense whatsoever, since gold over the long run is the ultimate inflation hedge of all time, bar none, case closed, discussion over. But what's happening over the short run is that gold investors are believing a myth or a lie that's often discussed in mainstream financial publications that says that as interest rates go higher, therefore it's less attractive to own gold since you can get a higher interest rate as opposed to just keeping your money in gold. That sounds fine on paper, and it often works as a self-fulfilling type of prophecy over the short run, because gold investors do end up selling their gold to chase those interest rates over the short run. But over the long run, every single time that we've seen higher interest rates due to inflation, that has not been the backdrop for a sustained gold price decline. So what we're seeing here is an illogical, short-term phenomenon, if you ask me, and you are asking me because you're here in this channel, and so I'm going to give you my take on it. And in the premium subscription, we have gone back and we've looked at data points for all these series of events, the 4 series of events, including showing that the strongest bull markets in gold in the history of mankind, since gold has been freely trading in 1971, the strongest bull markets have always occurred in a rising interest rate environment. Rising. Compare that to the current paradigm that gold investors are believing, which is that rising interest rates are bad for gold. Okay, so one of these narratives is correct and one is incorrect. And if you want to get all of the data that we looked at last week, make sure to click the link to the homepage. You can see what we're talking about as far as the actual historical examples of this, but I will give you the executive summary here that this cause and reaction of 4 events. Higher inflation as seen by commodity prices, number 1. Bonds selling off, number 2. Higher interest rates, number 3. And therefore gold investors selling their gold to chase higher interest rates, number 4. That has never been a sustained backdrop for a long-term precious metals decline. Never in over 50 years of freely trading gold prices. So the idea that this weakness is going to continue forever, even as interest rates move higher due to inflation, is not something that we believe here on this channel. And we are planning for the gold price to be reversing at some point within the intermediate future. Although that intermediate future could be a little bit further down the road, and there could be still somewhat lower gold prices as the nonsensical, self-fulfilling prophecy actually continues to manifest. One of the data points that I would like to bring up for your attention this week as we look at the big picture for gold, because it's easy to get caught in the short run. If we look at the big picture going back from 2001, 2002 through the present, and all the fancy colors here are labeled for you so you can pause the video and take a look at what we mean here by the broken, for example, the turquoise trends are broken trends. And you can see when a trend is broken, such as right there where my mouse is, it doesn't necessarily mean the price is going to skyrocket immediately, but that broken trend was never violated again, right? And then gold moved higher. So from a technical basis, what we want to talk about here is the difference in the nature of the decline that we saw after the peak in 2011, which was functionally similar to the peak just recently in 2020, within about $100 or so of one another. But what we want to talk about is the nature of these corrections. And this is one of the data points that we are studying that lead us to believe that this correction here in gold is not going to be the start of a 5-year bear market in gold and silver and related assets, but instead that it is going to be an intermediate term pullback before the final move higher for good above the former all-time high. So what are we talking about here? Let's zoom both of these in. We got 2 red boxes. We got 2 charts. Going back to 2011, notice how that after gold peaked at $19.20 per ounce, it then declined. What was it? 20% in 4 weeks. This is a weekly bar chart. So every one of these lines here, whether it's a red line for a down move or a black line for an up move, every line represents 1 week of buying and selling in the spot gold market. So from the peak at 1920 in 2011 down to 1535 in 4 weeks was approximately a 20% decline, as I said, in just 4 weeks. That is an impulsive type of decline. Boom, get me out. I'm out of here. This thing's going to zero. I'm leaving gold to store my money in fiat currency or something like that, right? It's just get me out. 20% in 4 weeks. Compare that to what we have seen this time from the all-time high. That is, and this was the chart as of yesterday when gold was a few dollars higher than it is today, but a 17% decline in 30 weeks. So it seems, rather difficult to sustain here for a lot of people, or it seems, really troublesome. But really, when you look at it, it's less of a decline that was seen from the previous peak. And not only that, it's taken 30 weeks to unfold. There are 30 of these 1 week bars here since the peak in August 2020. So these types of overlapping waves, this down, up, down, up, down, up, down, is what we call corrective type of price action. Compare that to impulsive type of price action that we saw at the last major peak. So here at iGold Advisor, we believe that this is a corrective price structure for gold, and that although there could still be some marginally lower prices, perhaps even into the mid-1600s, as that 4-part self-fulfilling nonsensical prophecy plays itself out, we believe that this market, that the majority of the decline is already behind us. We believe that we're closer to a bottom here than a top, relatively speaking, and that after what could be still a somewhat frustrating period for those people who just want to see gold go to $5,000, next week, but after a bit more decline that could be grinding in nature and perhaps not really catch any headlines, that after that type of price behavior, this corrective type of price action will be proven to be just that and will be a correction before the market gets ready to exceed both of these peaks for good. And in essence, what we'll be looking at here is what was essentially a 10-year bull market, a 10-year consolidation. Can you imagine followed by another 10-year bull market? Something of that magnitude appears to be what is getting ready to shape up. And we have plenty of more evidence for this. If you would like to witness that, please consider and go ahead, subscribe to our premium research service, where you will get every piece of data that is crossing our desks presented to you in video format such as this. But weekly videos tend to be 45 minutes to 75 minutes in length, depending on how much other stuff is going on in the markets. So this is how we still see the gold market shaping up. Remember, it gets harder and harder to stay on as the correction is continuing, both in price and in time. It's very easy to sell at the bottom. Is that what we want to do? If you have enjoyed this, I would encourage you to check out our homepage on Precious Metals Intelligence, being the name of the service, where, as I said, we do premium weekly videos for members only that cover not only gold, but also physical silver. We're still talking about the short squeeze. We cover the U.S. dollar, the U.S. stock market, the rest of the commodity complex. We cover the gold and silver mining sector. We also cover the exact gold and silver miners that we are buying and selling, with in-depth research reports that go directly to your inbox when we are buying or selling those gold miners. This is designed so that people can follow the exact research and the exact analysis that we are using here as a firm. If you're new to this sector, if you'd like to learn more and get an in-depth perspective on how investing in this sector goes from a technical basis, this is a service that is well worth your investment in your education. If you would like to speak to me, Christopher Aaron, one-on-one, please know you can reach me on the Consultations tab on our website. I take no funds, no fees, oh no, from any of the gold and silver miners that we were talking about, from any of the funds, from any of the brokerages or dealerships. Oh no. I work solely for the benefit of individual investors such as yourself. So, I will not get 100% of things right. No human being will, I believe. However, I can tell you that I have dedicated the majority of my adult working life to this market. We have a firm grasp on a number of things in this market, and I will firmly and solely look out for the best interest of you from an independent standpoint if you would like to speak via consultation. So we're watching here, guys, this, to bring it back to the center focal point, we're watching what is going to be a historical anomaly where gold investors are, bring it back, gold investors are selling their gold due to higher inflation. It is the most insane thing that I could possibly imagine. And the intermediary between that is the rising yields on bonds. But remember, yields are rising because bond investors are dumping their bonds due to higher inflation. That is not a reason to sell your gold. It's a reason to buy more. But that is what the market is doing. And remember, no one, especially no one here in this channel, ever said the market has to be rational. If you're going to be investing in these markets, you have to make peace in your heart, actually, and in your mind, with the fact that these markets are going to be irrational for weeks and months and sometimes even years at a time. If you can do that, you can succeed in the long run, and then you follow the signals as they're coming out. But if you expect the market to be rational every single day or even every single year, it's just too frustrating. So we have to kind of watch these things. We have to keep our core positions, and we have to let events play out as they must, but keeping an eye on the big picture. Thank you for joining this week. I will see you again soon. Take care of yourself.